do think we're going to see silver and gold bought back up here. Potentially silver works its way back to 100, maybe even gets back to 110 here. The charts paint a very clear picture of where momentum should take us, which is 106. And once you break through this invisible ceiling, you kind of pop into no man's land, a bit of a bubble territory, right? So we've seen the same with gold. It's happened twice over the past year where you hit this target and then it pops and everybody gets excited. The pullback, I think we could see a 40 to 60% pullback in silver. We saw a 32% pullback from the high in one day, which is the daily chart. You can see how it takes the staircase up and then the elevator down. That is typical price action, where people just don't care what they pay anymore. They just want in. There's a ton of margin calls, huge volume. Generally, a commodity doesn't move 32% in a day. So a lot of people think metals are just getting started. I think they're kind of coming to an end for a while, and there'll be a different asset class to take advantage of. And people are buying into precious metals, expecting the world to fall apart, all kinds of bad stuff to happen. Then the bad things are probably going to happen, and it's already priced into the metals. Most investors are behind the curve. The charts are pointing to type of price action that happens usually before a big reversal.
Yeah, what is happening in silver?
Yeah, well, the charts just whispered to me. They just kind of tell me what's going on. No, but the charts were pointing to this. So when you and I spoke last, I talked about how 106 was my measured Fibonacci target. Typically, once you hit that, if we can break through it, we're going to go into some parabolic emotional phase where it could blow up to 120, 130, 140. And that's pretty much exactly what happened. I was in Vancouver at the VRIC event, and it broke through 106 and it spiked to pretty much 120. And everybody kind of went ballistic. I think the energy in the air was pretty wild. But that's typical price action. When there is a mass kind of herd psychology play where a lot of people are piling into a sector because it's been hot for long enough that people are all aware of it, we tend to see these strong explosive moves. And they're fairly predictable. Like the charts paint a very clear picture of where momentum should take us, which is 106. But once you break through a Fibonacci target is, I call it, invisible ceiling. Once you break through this invisible ceiling, you kind of pop into no man's land, a bit of a bubble territory, right?
This is where technical precision quietly turns into emotional excess, and most investors confuse momentum with inevitability. As Chris Vermeulen points out here, Fibonacci extensions often act less like targets and more like psychological tipping points once crowd behavior takes over. Silver clearing 106 wasn't just a chart event. It triggered fear of missing out flows that historically account for over 60% of late-stage parabolic volume in commodities. The danger is that invisible ceilings don't come with structural support, meaning price discovery becomes emotion-driven instead of liquidity-driven. For portfolios, this is where upside feels safest, right before risk spikes. And what Chris Vermeulen explains next reframes why these breakouts rarely reward late buyers.
And we've seen the same with gold. It's happened twice over the past year where you hit this target and then it pops and everybody gets excited. So that's what we've seen in silver. And the pullback, I mean, I think we could see a 40 to 60% pullback in silver. We saw a 32% pullback from the high in one day, which is pretty wild. But that's not the type of pullback I'm actually looking for. I'm expecting we're still going to get a bigger pullback in metals. It's going to take several months to unfold because I think the equities market is very close to a peak here and it'll drag the markets down. But short-term wise, when we look at the charts, Elijah, the market is, the way silver moves is a little bit kind of like a meme stock, like GME and things like that, where everybody piles in, they drive the price to kind of short-term ludicrous kind of pricing. And of course, everybody piles in and then there's a mass exodus when they all leave. They all bail out very quickly. Now, silver is obviously a futures market. So futures and margin calls kick in very quickly, which is what I think happened on that day.
Calling a 32% single-day collapse, not the crash, sounds calm, but it's quietly unsettling if you understand leverage math. Chris Vermeulen highlights that futures-driven assets behave less like stores of value and more like liquidity traps when volatility spikes. Historically, silver drawdowns tied to equity peaks in 2008 and 2011 extended for months, not days, with total retracements exceeding 50%. Comparing silver to meme stock behavior exposes the real issue, prices being driven by positioning, not fundamentals. For investors, this means headlines celebrating rebounds can mask deeper structural unwinds. And what Chris Vermeulen signals next matters for anyone assuming the worst is already over.
There's a ton of margin calls, huge volume. Generally, a commodity doesn't move 32% in a day. So, as soon as you apply leverage to that, I think people with leveraged accounts, leveraged ETF trades on silver, who are trading futures on silver, there was just a lot of forced liquidation. And you could see it on the intraday chart. You could just see the volume picking up and the waterfall sell off, like on the 10-minute chart, just going off a cliff. So I think now we could get a bounce. There's a lot of selling pressure. Still, people are still in shock. They're trying to digest that move. But I do think we're going to see silver and gold get bought back up here, and potentially silver works its way back to up to 100, maybe even gets back to 110 here. So it's really going to come over the next couple of days. How is this sentiment going to stabilize? But I am still bullish. I do think it's going to get bought up and see as a bargain here for a lot of people.
Do you want to share kind of where we are on the charts? Obviously, things are changing by the minute, but kind of what you're seeing and getting a visual on that.
Sure, yeah. So if we take a look at the chart here, we got the chart of silver.
This wasn't selling. It was forced liquidation, and that distinction changes everything. Chris Vermeulen has repeatedly warned that when leverage dominates volume, price collapses faster than sentiment can adjust. Data from CME shows margin requirement hikes often coincide with 20 to 35% commodity drawdowns, followed by reflexive bounces that trap dip buyers. Yes, silver can rebound to 100 or even 110, but rebounds born from margin relief aren't trend confirmation. For everyday investors, this is where emotional bargain logic collides with mechanical risk. And what Chris Vermeulen explains next reveals why stabilization matters more than speed.
The daily chart, you can see how it takes the staircase up and then the elevator down. That is typical price action. I mean, it's a huge move, but this is what happens when we get into kind of a euphoric kind of phase in something where people just don't care what they pay anymore. They just want in. And that's kind of what we saw. We had a target here at 106. And then, of course, it blew all the way up to 121. And then it fell all the way back down to 72. So when we look at this chart, I believe it still may be under pressure for a few more bars. It might take a little bit more time for a lot of investors who are nervous to keep selling out, and it's going to keep some downward pressure. But I do think we're going to see this kind of work itself back up to the 100 mark, maybe even push up even higher before maybe it goes into a bigger correction. So that's what I'm trying to get a gauge on right now. The charts now have cleansed the air. We've definitely seen some damage done, and now we just need to see how this is going to unfold. And again, I think we're going to see some bargain hunters step in, and it's going to find support here.
Certainly, and I know your philosophy when it comes to holding precious metals. I mean, for the most part, you're in it for the trade, right?
The staircase up, elevator down pattern is classic late cycle behavior, and it's rarely friendly to passive holders. Chris Vermeulen often notes that these structures appear when upside participation narrows while downside liquidity widens. A drop from 121 to 72 erased months of gains in days, a reminder that volatility expands fastest after euphoria peaks. While bargain hunters may step in near 100, history shows these zones often become distribution ranges before deeper corrections. For portfolios, this is about risk containment, not hero entries. And what Chris Vermeulen outlines next clarifies why patience beats conviction here.
Is my understanding. A lot of our viewers also want to just hold long term, and I think that's a different kind of mindset. But right now, for those trading or wanting in some way to get in and out, and we can't give financial advice, but what is your perspective on that sort of mentality right now, or that sort of trade? Is it just kind of too risky given the volatile price swings at the moment, or do you think right now it's a buying opportunity? Your perspective on that?
Yeah, that's a good point. I think time frames is very important. So I just moved back to the monthly chart of gold. And for example, gold peaked out back in 2011. It went into a bear market, traded sideways forever. 2019 is when I put on this particular physical metal position. This is when I piled in, bought lots of precious metals. I also bought some on a pullback in COVID of 2020. I bought some more. And so literally I scaled out like right up here, about 40% of my position. So there's huge gains. This is kind of the long buy and hold. I'm not holding. I do want to exit once something goes parabolic. Like into this type of phase because I don't want to go through 10 years or go through potentially like 14 years to break even again, right?
The real risk here isn't volatility. It's confusing long-term conviction with short-term timing. As Chris Vermeulen often stresses, markets don't reward loyalty. They reward discipline. And gold's 2011 peak, followed by nearly 8 years of dead money, proves that point. Investors who bought without an exit plan waited almost a decade just to get back to even, while those who scaled out preserved capital and flexibility. The 2019 to 2020 accumulation window mattered because valuations were compressed, sentiment was poor, and downside risk was limited. Today's parabolic behavior flips that equation, increasing the cost of patience. What comes next, as Chris Vermeulen hints, is where time frame mistakes quietly destroy returns.
So I want to catch these moves when a new bull market starts. So this was a long-term trade. I'm still in it. We might still see gold push back up, and hopefully I'll be able to trim or close the rest out at a higher price. And silver is very much the same. When we look at silver, it's got this big parabolic spike. And as you and I have talked about before, if we go way back in time, things that go straight up like to come straight back down, usually at least for half of the move. And so silver was the same. I closed out at 113 and change right up here. Now we need to let it try and figure itself out and see if it's going to quickly pop and get bought back up as an opportunity, maybe even go higher. But so these were long-term investments. Again, I purchased silver back in 2019. Now silver is much more volatile. It ended up taking much more of a hit. I added a lot of silver on the 2020 dip, the COVID dip. And so we're up, hundreds of percent to the upside. But those are long-term plays. And now I want to, trim off because I don't want to hold through potentially a long time where metals might not go higher.
Parabolic charts don't signal strength. They signal compressed time and rising risk. As Chris Vermeulen points out, assets that move vertically often retrace 50% or more, and silver's history confirms that pattern repeatedly. The gains since 2019 look extraordinary, but that's precisely why trimming becomes rational, not bearish. When volatility spikes, forward returns statistically decline as price discovery resets and leverage flushes out. This is less about calling a top and more about respecting math and market memory. Investors ignoring this phase risk round-tripping profits, something Chris Vermeulen consistently warns happens when emotions override structure.
A lot of people think metals are just getting started. I think they're kind of coming to an end for a while, and there'll be a different asset class to take advantage of. But as you mentioned, that's a long-term play. As a short-term play, we got into silver. We caught a nice 20% move and closed out a trade somewhere back over here as a short-term trade. We got in, hit two of our targets, closed it out. And then we did the same with gold. So we trade both of them. We got into a trade over here for gold. We closed it out right over here, up here. So I do provide both, right? I have the long-term buy and hold, and we avoid multi-year bear markets. And then I have short-term trades where we just get in, hit the targets, get out as more short-term kind of gains to kind of juice up the portfolio a little bit here and there. So it really is important for people to understand what time frame you're on. I'm a buy and hold when it comes to physical metals. It's just, I believe we're at a point now where I believe we might go a long time without actually huge gains. Usually people buy the rumor, sell the news, right? It's the same we see in the stock market. People buy into a stock, it goes up, you get really good earnings, and then the stock crashes.
The most dangerous narrative right now is that this time is different for metals. Chris Vermeulen has repeatedly highlighted how late cycle enthusiasm often peaks just as capital should rotate elsewhere, and that's exactly what this setup resembles. Short-term trades worked because volatility expanded, not because fundamentals suddenly changed. Long-term holders face the real risk of stagnation, where opportunity cost quietly erodes portfolios, while headlines stay dramatic. Markets don't move in straight lines, they rotate, and ignoring that reality traps investors in yesterday's winners. What Chris Vermeulen signals next is about where capital flows when metals stop leading.
Precious metals are the same. People are buying into precious metals expecting the world to fall apart, all kinds of bad stuff to happen. Then the bad things are probably going to happen, and it's already priced into the metals, right? It's always most investors are behind the curve. They're buying, anticipating when the bad news comes, it's going to send gold through the roof. Well, gold and silver have already, to me, have almost kind of priced it in for a while. And so I want to step back from a long-term view and let it figure itself out. And we could see, gold and silver flatline and pull back for a very long time. It could be several years. We don't know. And I don't want to hold something long-term at this point as an active investor if it could go sideways for a long time when it has clear signs that it looks like it's peaking.
This is where macro psychology quietly does the damage. As Chris Vermeulen has noted, markets price expectations long before headlines confirm them, and crisis trades often peak ahead of actual turmoil. Gold and silver already reflected fear premiums, leaving little upside once reality arrives. Flatlining for years isn't bearish, it's capital stagnation, and that's lethal for active investors. What Chris Vermeulen points to next is how capital reallocates after fear trades unwind.
Should people get in? What should they do here? I think obviously things have been repriced a little bit, but in my opinion, for a short-term trader, I would kind of steer clear because we might just see metals drift sideways and up very slowly, but then get hit with more selling and go into a deeper correction. If you're a long-term investor, I'd give it some time. I mean, I think it's best to let the dust settle, see where things kind of peak out. I'm not a huge fan of moving into the space right now. I mean, I'm doing the exact opposite. I'm scaling out, right? So generally, it's not ideal to move. I don't want to move in when it's at a point where everything from my perspective is saying start locking in profits and protect your capital.
This isn't pessimism. It's what capital preservation looks like when charts stop confirming stories. As Chris Vermeulen has warned before, late-stage breakouts that fail quickly often mark exhaustion, not opportunity, and platinum's damaged structure fits that pattern. Sideways drift after violent moves historically precedes either deeper corrections or long periods of dead money, both hostile environments for traders. Long-term investors face a different risk, opportunity cost while capital sits idle. Scaling out isn't fair, it's discipline when upside asymmetry disappears. And as he consistently emphasizes, protecting gains matters more than chasing the final 10%.
Because the charts are pointing to, this is the type of price action that happens usually before a big reversal.
And when it comes to other assets, is there anything that you're looking to maybe you think is a good long-term investment at the moment?
That's a tough one. I don't think there's a whole lot that's really exciting to be at this point. Like I think equities are a high risk play. They're still in an uptrend. We're still long stocks, but the market is definitely showing signs of weakness and fatigue. Typically when we see gold and silver do this type of price action, it means we're very close to an economic top, something big, and that'll obviously send equities lower as well. And precious metals I'm scaling out of. I think the play to me is to protect your capital. And sometimes to do that, you just have to step aside. So move to cash till there's a new trend sorted out, to let this kind of volatility work itself out. If it builds a platform and things start to go higher again, you just jump back in and you ride the next big flag, the next big wave to the upside in metals or stocks.
This is the uncomfortable phase markets create when risk is everywhere, but opportunity is scarce. Chris Vermeulen has pointed out that late cycle uptrends often mask internal weakness, and equity fatigue usually appears before price rolls over. When metals spike violently while stocks grind higher, history suggests liquidity stress is building underneath. Cash isn't bearish here. It's optionality, waiting for structure instead of noise. Investors underestimate how powerful sitting out can be during regime transitions, and as he reminds viewers, missing the middle of a move beats getting trapped at the end of one.
Now, you've really been calling for this pullback in metals or crash in metals for quite a while, and you've been comparing it to the crash of the stock market that you have been predicting. Now, you've been mentioning how in 2008, for example, you saw final blow off top before metals pulled back, while the stock market was kind of having its first leg down. So do you want to, now that we've seen this pullback in metals, or this crash really in gold and silver, did you want to compare kind of where are we in that cycle with the stock market and precious metals?
Yeah, I mean, I don't believe this. This is where I think a lot of people are going to get caught off guard. I think people are going to think now that, the 20% pullback in gold in like a couple trading sessions, the 32% pullback in silver. I think people think that was the crash, and I don't believe that was the crash. In fact, metals I think could still potentially even push higher. So if we look at these two charts here, this candlestick chart on the left-hand side is the S&P 500 when it hit all-time highs. And then it put in a peak and started to struggle a little bit. The yellow line is the chart of gold.
This is where investors confuse volatility with completion. Chris Vermeulen has repeatedly highlighted that sharp pullbacks often serve as shakeouts, not finales, especially when broader cycles remain unresolved. In 2008, metals didn't collapse immediately. They surged after equities cracked, catching consensus completely off guard. A 32% silver drop feels catastrophic, but context matters when liquidity rotations are still forming. The bigger risk is assuming the move is over, simply because it was painful. As he has cautioned, markets hurt the most people at the wrong time, not the obvious one.
And if we take a look at the right-hand side, we've got the S&P 500 hitting all-time highs, and then the yellow line is gold. And what we've only seen is really just a pullback, a blip. We still could see metals go higher. And if we were to just scroll forward on 2007 chart, notice the candlestick chart down below. The stock market starts to sell off. The money comes out of this equities market and it shoots into gold, silver, platinum, and palladium and sends it sharply higher. So I believe we could actually still see that. Bull markets are always trying to buck people off. The pullback in gold and silver, you could argue is still just a buck. Like, we could go back to gold, and we've seen this before. When we came over here, this was earlier. This was in October of last year. We saw gold have the very similar move. It took off. It hit our 100% measured move right here, which is where we closed out a short-term position. And then it went into this euphoric kind of blow-off phase. And then, of course, it got hit very hard. And a lot of people thought that was the peak. They're like, okay, it is now reversed.
This comparison exposes why timing matters more than headlines. Chris Vermeulen has shown that during late cycle equity tops, capital often rotates into metals after stocks begin breaking down, not before. The 2007 to 2008 sequence wasn't intuitive, and that's why most investors missed it. What looks like a violent pullback may simply be a reset designed to eject weak hands. History shows bull markets rarely end cleanly. They confuse, fake out, then continue. The danger isn't volatility. It's misreading where we are in the cycle, something he consistently urges investors to respect.
But all it did was anybody who's late chasing it put them through this roller coaster ride. It restabilized, and it came all the way up. We actually closed out our gold position here on the 28th. Because it hit our 100% measured move. Gold had the blow off top, just like silver, and now it's correcting again. So gold and silver really are doing kind of these. They're both the same. They have a big run up, then they shake everybody up and tries to scare them out. Then it has a run up, and it tries to shake people out. It has a run up, and now the precious metal space is trying to shake things up. Obviously, it's a very big move. It looks like some damage has been done. But when we step back and look at the big picture, the stock market hasn't peaked yet. And I still believe we could see the gold and silver potentially base or even go higher going forward here. So that's where we're at. We're at this big consolidation. We just have to see how the metals are going to react. Are they going to stabilize? Are they going to build a foundation? I think this is just a crowded trade. A lot of people piled in very quickly. It was kind of headline. Everybody was like on a hair trigger to lock in profits.
This is how late cycle trades punish impatience without actually ending the trend. As Chris Vermeulen has explained in similar setups, repeated shakeouts are designed to exhaust emotional capital, not confirm tops. Closing positions at a 100% measured move reflects discipline while acknowledging the broader equity cycles still matter. Historically, metals consolidating while stocks remain elevated often signals unfinished rotation rather than collapse. Crowded trades unwind violently, but foundations form quietly. What matters next is whether buyers step in without headlines, a condition he watches closely before declaring the next directional move.
Felt like, and as soon as the selling kicked in, everybody just ejected. And there's a lot of people trading momentum there, meaning a lot of people will put in stops under each previous day or intraday lows. So when we start to see this sell-off, it just triggers all kinds of orders, forced orders, especially the margin calls. So to me, this is actually a pullback at this point, still within the trend. We do need to see it stabilize, or else I might be getting out the rest of my positions. We still hold a good chunk of our metals position, but right now we still got to give it the benefit of the doubt. The long-term trend is still intact. This is just an emotional, everybody jumping out the window really quick.
This sell-off wasn't driven by fundamentals. It was mechanical, fast, and unforgiving. Chris Vermeulen often points out that stop clusters and leverage turn normal pullbacks into artificial crashes, especially in futures-heavy markets like metals. Margin calls don't ask questions. They liquidate first and explain later. That's why stabilization matters more than speed here. If structure holds, patience wins. If not, capital protection comes first. Investors should recognize the difference between emotional liquidation and trend failure, a distinction he stresses when markets appear chaotic but aren't broken yet.